Well, good afternoon, everyone, and thank you for joining us for another installment of our Thursday webinar series. We do webinars every other Thursday, and we're happy that you were able to join us for today's presentation on the hidden needs and special needs planning. And before I get to today's topic, I just want to take a little bit to talk about who INSMAX is and what we do. We share insurance ideas and concepts that solve real-life problems. We work for our advisors. We have 20 years experience in the brokerage business, and we work with more than 30 of the major insurance companies in the industry. We provide training and consumer-approved marketing content so you can approach your clients. We handle your contracting and licensing when your clients want to implement a plan. We handle pre-underwriting to uncover and address your clients' specific impairments and determine the best insurance company for their risk. We give our advisors all the forms they need to complete applications, and we review completed forms for errors and omissions. We handle the entire underwriting process from application submission and scheduling exams to obtaining medical records and negotiating better offers with underwriters. So in short, we're a full-service brokerage company that you can trust. I like to say we're insurance experts, so you don't have to be. Now let's get into today's topic. Disability exists in every community, regardless of the demographics. Try this exercise the next time you're out driving. Take a look at the cars in front of you and their bumper stickers. It probably won't take too long for you to spot one of these logos. This emphasizes the level of awareness for different types of disabilities, as these organizations are not just supported by families that are directly impacted, but also their friends and volunteers everywhere who care and show their support. The need for planning is also growing. Let's take a look at some statistics. 54 million people, or about 20% of all Americans, have a physical, sensory, or intellectual disability, according to the National Organization on Disability. The U.S. Census Bureau says that 20% of Americans between 16 and 64 suffer from some form of physical, mental, or emotional impairment, and many of them are outliving their parents thanks to improved care and medical technology. Out of 72 million families included in the U.S. Census Bureau report, 2 out of 7 reported having at least one family member with a disability. That's nearly 30% of all families, and about 8% of all Americans under age 20 have disabilities. So with numbers like this, finding clients to discuss special needs planning with is not difficult, and you probably already have clients facing these concerns, and you just don't know it. Some of the most common disabilities are either that of a physical or developmental nature. Muscular dystrophy and multiple sclerosis belong to the physical category, while autism, Down syndrome, and cerebral palsy are developmental issues. So what's the purpose of special needs planning? You have a child or a loved one that may not be able to take care of themselves after the caregivers are gone, and you want to provide a lifetime of medical care and supervision while controlling finances and allowing them to maintain their standard of living. And careful planning will ensure that they continue to qualify for government benefits and services. Generally speaking, there are 3 types of special needs trusts, 2 that are funded by assets of the trust beneficiary, and 1 funded by assets of the parents. The first type of trust is the first-party special needs trust, which is funded by assets of the trust beneficiary. This type of trust most likely is not going to apply unless the special needs individual has received an inheritance or settlement that could disqualify them from government programs. It must be established by the parents, a legal guardian, or the courts, and this type of trust needs to be irrevocable with a trust agreement that includes a Medicaid payback provision to provide reimbursement to the state Medicaid agency upon the death of the beneficiary. The second type of trust is the pooled special needs trust, which is also funded by the trust beneficiary's assets. This type of trust can be established by the special needs individual if there are no living parents or legal guardian of their property. This type of trust can be perfect when the parents have already passed away and have left assets to the special needs individual without proper planning in place. Now, the third type of trust is a third-party special needs trust, which is funded with assets owned by parents, relatives, or friends. It can be used during the parent's lifetime for ongoing expenses that are not covered by government programs, and there's no Medicaid payback requirement, so anything left in the trust can be distributed to trust remainder beneficiaries. This type of trust can be revocable and allows flexibility to change the trust agreement and also change trustees. A professional corporate trustee can serve jointly with a family member trustee, so the family can still be involved in the decision-making process. So let's take a look at typical planning. Parents are concerned about ongoing care that's going to be provided after their passing and want to make sure that there's a lump sum of money available to provide that care. The parents have worked hard with an attorney to establish the Special Needs Trust, and they've named the trust the beneficiary of the life insurance policy. The trust agreements outline how the trustee will distribute funds for medical, dental, housing, personal care attendance, physical therapy, vacations, and even recreation. With the proper planning, the beneficiary can still qualify for government programs. So let's take a look now at some of the hidden needs. So hidden need number one would be long-term care. Parents will spend their whole lives caring for their child, but who will care for them when they're older and they're unable to take care of themselves? They can't rely on the child for help, and though the thought that they could take care of each other is nice, what if one spouse dies and is not there to take care of the other? Also, the physical and emotional strain of trying to care for a spouse and a special needs individual at the same time might be too much to handle alone. Long-term care can cause a strain on the family's budget, their standard of living, and jeopardize the special needs planning. The odds of somebody 65 or older needing some type of long-term care is over 70%, and the average cost of an assisted living facility runs at about $4,000 a month. Hidden need number two would be death of the breadwinner. Almost 50% of families with a special needs child will have one spouse drop out of the labor force to become a full-time caregiver. The death of the working spouse could destroy the family's finances, leaving the family without the ability to pay for monthly expenses, fund for retirement, pay for medical care, and it could even jeopardize other parts of their special needs planning. The third hidden need is death of the spouse. And when I say spouse, now I'm talking about the non-working spouse who's the full-time caregiver for the special needs child. This might be one of the biggest hidden needs. Just because the non-working spouse is not earning income doesn't mean that there's no financial risk. The death of the non-working spouse will require the working spouse to find and pay for a new caregiver. They may also have to take reduced hours at work, which could compromise their career advancement and result in a loss of income. The fourth hidden need would be retirement assets. Having a special needs child means there are additional expenses and there are limitations on a family's earning capacity, and if parents may be worried that they're not able to save enough for a comfortable retirement. If they're one of the 50% of families with only one working spouse, then they can only take advantage of one employer-sponsored retirement plan. Another concern would be, what if they need money for unexpected expenses prior to age 59 and a half? And the fifth hidden need would be a disability claim. Here again, we have our assumption about only one working spouse, and if the breadwinner becomes disabled, it could actually put more strain on the family than death. There will be additional medical expenses on top of the loss of income, and this could financially destroy the family and wreck other planning that they've done. Now let's take a look at a case study for a special needs family. Here we have Rick and Molly, ages 44 and 41. They've got a special needs child, Lloyd, who's 5, and they've already taken the first step to protect and plan for Lloyd's future by purchasing a $500,000 survivorship policy, and they've created a special needs trust. Now they want a comprehensive plan that addresses all the hidden needs. Who's going to take care of them when they're older? How will they maintain their finance if one of them dies? Will we have enough savings and income in retirement? And how will we maintain our standard of living and plan if the breadwinner becomes disabled and can't work? So let's look at some solutions that address these needs. Will there be enough money set aside for our child? So they're going to have $500,000 survivorship benefits with a special needs trust as the beneficiary. We know that the survivorship policy is the most cost-effective way to leave a lump sum. Who will care for us if we can't take care of ourselves? As we discussed earlier, the average cost of an assisted living facility runs about $4,000 a month, and 70% of all people over 65 are going to need care. So they're going to purchase a $4,000 monthly benefit long-term care policy with a 3% inflation option, so the monthly benefit can keep up with the rising cost of care. What if the breadwinner dies prematurely? Well, we can cover this with a 20-year term policy that will last them until retirement while they're in their working years. What if the non-working spouse were to die prematurely? So here we're going to use a $500,000 indexed universal life policy. The death benefit proceeds can be used to pay for a new caregiver so the working spouse can continue to work and earn. Will we have enough money saved and income in retirement? Well, again, we're going to use a $500,000 IUL policy on the working spouse. So both spouses will have IUL policies funded as 20-pay premiums so that they're fully funded by retirement, and they're going to build up a pool of $561,000 of cash value by the time funding is completed. And lastly, how do we afford everything if the breadwinner gets sick and can't work? Well, we protect the future income earnings by purchasing a disability policy that's going to cover them until age 65. So let's look at a summary of what their comprehensive plan looks like, or what I like to call their financial house. Let's see who's provided what coverage. So the special needs child is going to have $500,000 in a special needs trust. The breadwinner is going to have a total of $1.5 million of death benefit protection, just about $1.5 million of disability income protection. They're going to have $4,000 per month of long-term care benefits that are going to grow to about $400,000 by age 80. And their IUL policy has a chronic illness rider, which allows them to access the entire death benefit should they need long-term care services. So a total of about $900,000 of long-term care benefits by age 80. The non-working spouse also will have $500,000 of death benefit, a $4,000 per month long-term care benefit that's going to grow to $450,000 by age 80, along with their $500,000 pool of benefits from their IUL, thanks to their chronic illness rider. So the total cost over 20 years is $561,000, but when we look at the cash value, because we funded it short pay to retirement, there's going to be $563,000 of cash value in there. So I like to equate this plan to a 20-year mortgage. You're going to pay $2,200 per month. You've got a comprehensive plan that's under one roof, and after 20 years, it's going to be paid off. You're building equity just like you would in your house. Now, this comprehensive plan is an opportunity for $28,000 of commission. While your clients might not choose to purchase everything that's proposed, there are multiple opportunities for you to mix and match. It's also a good way for you to stay in front of your clients to review unimplemented parts of the plan, and they can add pieces over time. With that, I'd like to thank everyone for joining us today, and we'd love to help you with the opportunities you're sure to uncover. Also, a quick plug, our next webinar is going to be taking place in 2 weeks on policy loan rescue using mirrored loans. We'll discuss the policy loan time bomb that could be present in your client's policy and also how to defuse it. We encourage you to reach out to us to discuss your next case, and you can contact us at 610-382-5000 or email us at info@insmax.com. Thank you, everyone, and we hope you can join us again.